Hello students, we have already completed the concept of capital structure and financial leverage, and we learned that whenever in an organization the financial management decisions are taken, the financing pattern is also decided. And when the financing pattern is decided, there is mix between owned and borrowed funds, that is debt and equity mix in long-term funds, and that is what is called the capital structure. And the financial ratio between debt and equity in total capital is called the financial leverage. And this financial leverage can be favorable, can be unfavorable. Whenever we have learned that the situation of financial leverage means the proportion of debt to equity in total capital, and that decides the cost of debt, whether the debt has been cheaper or it has been costlier. That depends only on the ratio which is maintained in raising funds. And if that ratio is properly maintained, always we see that the return which comes from that fund once it is raised and invested, that is always greater than the rate of interest which the company pays, and that leads to favorable financial leverage situation. Otherwise it leads to unfavorable financial leverage. So both can be the situations. If there is no optimal mix between debt and equity, it will be unfavorable. If there is proper mix, we will see that always the risk return combination is going to prove profitable for the business organization. And whenever this risk return combination that proves to be profitable, it is advisable to go for trading on equity, because trading on equity means always debt in the total capital, when it is mixed with equity, the combination is proving to be cheaper and it is giving greater profitability in the form of higher earning per share. So to the extent that the debt proves to be cheaper, it is always advisable to avail debt. So only to the extent that the cost of equity gets unaffected. The time when the cost of equity gets affected, it is going to impact the market price of the shares, and the market price of the shares will fall down. That is why there is need to maintain proper mix of debt and equity in total capital. We will be learning it with the help of examples. What is the impact of financial leverage on profitability, that means on earning per share, that can be analyzed with the help of EBIT-EPS analysis. So EBIT means earning before interest and taxes, and EPS means earning per share. What is the impact of earning before interest and taxes on earning per share? Let us learn. And when can the combination be considered as favorable and unfavorable, so that the company may have optimum mix of debt and equity. Let us take example. Now let us understand the situation first of all, on the basis of which we are going to analyze EBIT and EPS. What is the effect of, or how does this combination work in any organization? Let us see. Now, for example, an organization wants to invest total funds of rupees 30 lakhs. So total funds used or total funds invested, that is 30 lakhs. And there are three situations. First situation, this situation is of debt. In first situation, we see that the debt is nil. That means it is no debt situation. That means the entire fund that has been raised, 30 lakhs, that has been raised from equity. That means owned capital. In the second situation, we see that debt has been raised of rupees 30 lakhs. So out of total funds used, 30 lakhs, in the second situation, the debt has been raised of 10 lakhs. That means 20 lakhs is equity investment. So, and the third situation, we see that the debt has been raised of rupees 20 lakhs. That means of total investment of 30 lakhs, if 20 lakhs has been raised from debt, that means 10 lakhs have been raised from equity. Now we will be understanding what is the impact of debt, no debt, and increasing the proportion of debt in total capital on earning per share of a company. Let us understand. For that, there is need to have analysis of EBIT and EPS. So if the debt is raised, the interest rate is 10%. That means 10% interest will have to be paid on debt. And the tax rate is 30%. Always we have seen that on income, on earning, tax also has to be paid, and the tax rate is 30%. And EBIT, that is earning before interest and taxes, that is rupees 4 lakhs in case of company A and rupees 2 lakhs in case of company B. So we will be taking two situations of two companies, and we will be computing EBIT-EPS analysis and seeing what is the outcome. Let us see. So EBIT-EPS analysis in case of company A. How it is calculated, let us see. We have already learned there are three situations. So in company A, situation 1, it is no debt situation. Situation 2, 10 lakhs debt, that means 20 lakhs equity. And in situation 3, 20 lakhs debt, that means 10 lakhs equity investment. Now let us see how the calculation takes place. EBIT is already given. In case of company A, the earning which the company has is rupees 4 lakhs, and that earning is before interest and taxes have been paid. That means on that earning, interest and taxes will also have to be paid. Let us see how the calculation proceeds. So EBIT in all the three situations is same. It is 4 lakhs, 4 lakhs, 4 lakhs. Now from EBIT, interest is subtracted, and that interest is interest on debt. If there is no debt, then no interest will be paid. If there is debt, always the interest have to be paid on the rate at which the debt has been raised. And in the case it has been mentioned that interest rate is 10%. So always interest will be paid on debt at the rate of 10% on debt. So let us see. The first situation is no debt situation. So no interest will be paid because no debt has been raised. So there is no need for interest to pay. In the second situation, we see that rupees 10 lakhs have been raised through debt. That means 10% of 10 lakhs will have to be paid as interest on debt, and that will amount to 1 lakh. 10% on 10 lakhs. This will be, that means 1 lakh will be the interest paid in situation 2. And in situation 3, we have seen that 20 lakhs have been raised through debt. That means 10% of 20 lakhs. And that will amount to 2 lakhs. That means 2 lakhs interest has been paid. So after interest has been paid, what will be the earning after paying interest and before taxes? Still the taxes have to be paid. Only the interest has been paid. So we are going to subtract the interest amount with EBIT, and what do we get? If we subtract, we get in situation 1 4 lakhs, in situation 2 3 lakhs, and in situation 3 2 lakhs when the interest amount has been deducted from EBIT. And this 4 lakhs, 3 lakhs and 2 lakhs is earning after interest before taxes, or it may also be said earning before taxes. In first situation, earning is 4 lakhs, in second situation, earning is 3 lakhs, and in third situation, earning is 2 lakhs. Now, tax has to be paid on this amount. That means earning after interest, and the tax rate is 30%. Tax on earning before taxes. So 30% of 4 lakhs will be 1,20,000 in situation 1. 30% of 3 lakhs will be 30% interest, 30% tax on this amount. We have learned. Now this is also 30% on 3 lakhs, on 4 lakhs, on 3 lakhs, and 30% on 2 lakhs. 30% on 2 lakhs will be 60,000. That means 1,20,000 in first situation, 90,000 in second situation, and 60,000 in third situation. The tax is paid. So we are seeing, you can just observe here that in situation 1 where no debt has been raised, the tax rate has been higher. In situation 2, when the debt has been raised, we see that debt is deducted from tax, and that makes debt cheaper. In first case, 1,20,000 is paid. In second case, we see that with the proportion of debt in total capital, it is proving itself to be cheaper. With increasing the amount of debt in total capital, we see that in the third situation, the debt has come out to be more cheaper, or debt is raised at a lower rate because the amount has been deducted, the interest amount has been deducted from tax, and that is making debt cheaper. After this, whatever remains, now we are going to subtract earning before interest and taxes minus the tax which has been paid, and that comes out to be 2,80,000, 2,10,000 and 1,40,000. And this is earning after taxes. That means both interest and taxes have been paid now, and this amount is coming earning after taxes. Now we have to calculate earning per share, and number of shares of rupees 10 each, the face value of the share that has been taken, rupees 10 each share costs rupees 10 each. So in case of situation 1, we have seen that the whole amount of funds that has been raised, 30 lakhs from owned capital. That means 3 lakh shares at the rate of 10 each. In second case, 10 lakhs from debt, that means 20 lakhs from equity, that means 2 lakh shares at the rate of 10 each. And in third case, 20 lakhs that has been raised from debt, that means 10 lakhs that has been raised through equity, that means 1 lakh shares at the rate of 10 each. So 3 lakhs at the rate of 10 each, 2 lakhs at the rate of 10 each, and in third case 1 lakh at the rate of 10 each. And then we calculate earning per share. Earning per share is equal to earning after taxes upon number of equity shares. That is why we have put here number of equity shares. In first case it is 3 lakh equity shares, in second case it is 2 lakhs, and in third situation it is 1 lakhs. If we assume that the face value of the share is rupees 10 each. So earning per share will be earning after taxes upon number of equity shares. That comes out to be, in first case, that means earning after taxes in first situation is 2,80,000 upon number of equity shares is 3 lakhs, and that will come out to be 0.93. In situation 2, the earning after taxes is 2,10,000 upon 2 lakhs, that will come out to be 1.05. And in situation 3, earning after taxes is 1,40,000 and number of equity shares is 1 lakh, that will come out to be 1.40. So what do we see? That the earning per share is rising. Why it is rising? In first situation it was 0.93, in second situation it rose up to 1.05, and in the third situation it rose up to 1.40. So earning per share is rising when the amount of debt that is raised to meet the investment requirements, and that debt is proving itself to be cheaper, because with the higher amount of debt in the total capital, we see that the earning per share is increasing. And this situation is what is called favorable financial leverage situation. And it is always advisable in such situation to go for trading on equity, because it is profitable situation when the debt is proving itself to be cheaper and it is giving higher returns. Let us take company B now. We have already seen the situation of company A. Now company B, the other things are same except one thing, that in case of company B, EBIT is 2 lakhs. In case of company A, it was 4 lakhs. In case of company B, EBIT is 2 lakhs. And if EBIT is 2 lakhs and you calculate in all the three situations, you will observe that the earning per share in case of situation 1 is 0.47. In case of situation 2, it is 0.45, that is reducing. And in case of situation 3, the earning is coming out to be nil. After the calculation has been done in the same way, what does this show? This shows that with the increasing amount of debt in total capital, the earning per share is falling. Why it is falling? Because debt is proving itself to be costlier. So every time debt doesn't prove itself to be cheaper, only up to the extent that the risk return combination or the mix between owned and borrowed fund doesn't affect the cost of equity. To that extent only debt proves itself to be cheaper. Otherwise, if you go beyond that extent and keep on raising the debt, keep on raising the funds with debt capital with an expectation that it is always going to give you higher return, it is not advisable. So what do we conclude? We see that in company A, the earning per share is rising with higher debt. Why? Because it is favorable financial leverage situation. And favorable financial leverage situation occurs when the cost of debt is lower than the return on investment. That is, return on investment is always greater than the interest paid on debt. And return on investment can be calculated with a formula EBIT upon total investment into 100. Let us see. In case of company A, EBIT is 4 lakhs, total investment is 30 lakhs into 100, and that will come out to be 13.33. In case of company B, EBIT is 2 lakhs, total investment is 30 lakhs, that will come out to be 6.67. And the cost of debt, that is the rate of interest which the company is paying for debt, that is 10% in both the cases. So in the first case, you can see that if the return is coming out to be 13.33% and the interest rate is only 10%, that means always the return is more than the rate of interest. Whereas in second case, we see that the return is 6.67% and the interest rate is 10%. What does it show? It shows that the debt is proving to be costly, because with increasing amount of debt, the return, that is not coming that much. So this is unfavorable financial leverage situation. So whenever there is favorable financial leverage situation, it is advisable to go for trading on equity, whereas when it is unfavorable financial leverage situation, advisable not to go for trading on equity, because trading on equity means by increasing the proportion of debt in total capital, the earning per share is increasing. This shows that debt is proving to be cheaper. But this doesn't mean that there should be reckless use of debt in raising funds. Always it should be kept in mind that the mix between debt and equity should be optimal. It should be mixed in such a way that the returns which is coming out from that mix is greater than the cost of funds, so that it will lead to increase in shareholders' wealth. So no reckless trading on equity. Always risk return combination should be such that it leads to increase in shareholders' wealth. So with this, we have completed EBIT-EPS analysis, which helps to understand the impact of financial leverage on profitability. After this, we will be understanding the factors affecting capital structure in our next class, and then the capital structure part will be completed. For the time being, we stop here, and rest will be continuing in our next lecture. Thank you.